So each month, the racing bicycle company, from now on, the RBC, they must generate at least 80,000 in total contribution margin to break even. What do we mean by break even? Which is the level of sales at which your profit is zero. So what does it mean? It means on break even, your fixed cost must be equal to your contribution margin, right? If that's also the 80,000, then here would be a zero answer. So in order to find out the break even, remember that it is equal to contribution margin. It means contribution margin in total must be equal to, this is total, not the per unit, must be equal to at least the fixed expense so that we can have a zero profit. So let's talk about its example. If the RBC company sells 400 units in a month, it will be operating at the break even. How? So we know that sales price 500. So where this figure came from? 2,000, 200,000, 400 multiplied by the 500, which is the selling price. Answer is 200,000. 400 multiplied by 300 variable cost, 120,000. Answer remain 180,000, right? Or you see here the CM minus fixed cost is equal to 0. Or in other sense, the break-even condition is if contribution margin is equal to fixed cost, then we have a break-even. Right? This is the rearrangement of this equation. Any question? If no, then let's move on. So now our other definition in which we talk about after covering fixed cost, whatever we sell, the contribution margin directly contributes to the operating income. Now we are proving that argument. So if RBC sells 401 bikes, the net operating income increased by 200. Let's talk about this. So where this 200,500 came from? We have 401 units and each price 500. So the answer is 200,500. 401 multiplied by 300, answer is 120, 300. And sale minus variable cost. So this is the operating contribution margin minus fixed cost, right? Now recall our second definition of contribution margin. So after covering fixed cost, so we know that our fixed cost is going to be covered on 400 units because 400 units are break even. We just proved in our previous slide that if we sell 400 units, then our profit is going to be 0, right? Or at 400. So if we sell one more unit, and remember, the contribution margin is 200, isn't it? The operating profit is 200. So that is the beauty of contribution margin approach. You don't have to make the complete income statement. Just remember that your break even in units are 400, and now above 400, whatever you sell, if you sell 2 above 400, 402 above, then 2 multiplied by the break even, that would be your operating profit, right? So that definition, that after covering fixed costs, essentially we are building that argument if you are on break even. So after covering fixed cost, whatever units you sell, multiply by the break even. That is your operating income, right? So we do not need to prepare an income statement to estimate profits at a particular sales volume. Simply multiply the number of units sold above the break even by the contribution margin per unit. If racing bike sells 430 bikes, its operating income will be 6,000. How? Because contribution margin is 200, and how much above we sell? 430 minus break even 400. So 200 multiplied by 30. Answer is. So that is a very nice application for the students who want to open their business, and also those who are working in as accountant or managers. So they know that how much we need to sell and what would be our profit. And if this month we sell 30 bikes above our break even, then our profit now reaches to 6,000, right? And now cost volume profit relationship in equation form. So we know that profit is equal to, let me derive this. We know that profit is equal to sales minus cost, right? We have sales, we have divided this cost as variable cost plus fixed cost. Using mathematical property, if negative is before the parentheses, then it would be sales minus variable cost minus fixed cost. That would be our profit, right? So we define that total cost is equal to fixed cost plus variable cost, right? So this is the equation for profit. Okay, now, so this equation can also be used to show the profit profit RBC earns if it sells 401. So notice the answer of 200 mirrors our earlier solution. So if we put the values here, see, total sales are 401 multiplied by 500. 300 multiplied by 401 is our variable cost, and then our fixed cost 80,000. So you see here, our profit is exactly equal to our contribution margin. Rather going into the format in which you just first collect sales and then minus variable cost and then minus fixed cost, you find out the operating income, or you are going through with the equation format, just notice that your break even is 400. Above you sell 1 unit, so 1 multiplied by your contribution margin, that would be your operating profit. That's it. So from here, we are going into a little bit more advanced formulas. Okay, now let's segregate all these total sales into per unit sales. Variable expense into per unit variable expense. Can we trust on per unit fixed cost? No. So that's why we are not dealing the per unit fixed cost. Here we go. So we know that sales can be calculated through quantity sold multiplied by price per unit. So Q and P, right? Similarly, Similarly, with the variable expense, variable cost per unit multiplied by quantity, and fixed cost is fixed cost because we are not segregating it into per unit. So we can just switch sales with price per unit multiplied by unit sold minus volume variable cost multiplied by the units sold. Right? So what do you think? See something common here? It's a mathematical property. Q is common here. So we just take out Q. Or if you want to prove that one, again, it is the same thing. 500 multiplied by 401, 300 multiplied by 401, minus 80,000, answer would be 200. This formula also proves that we are going in the same direction. So we know that CM per unit, or if it is often useful to express the simple profit equation in terms of unit contribution margin, so we know that sale price per unit minus variable cost per unit is our CM. So if you see our equation, so in this Q is common, so we take Q. So sale price minus variable cost per unit, we replace it with the CM. So we left with contribution margin multiplied by quantity minus fixed cost. So I'm going to do that on a white screen here. So we know that profit is equal to sales minus total cost, and then we segregated sales minus fixed cost minus variable cost, and then we rearrange with the per unit stuff. How total sales can be calculated, price into quantity minus how variable cost can be calculated minus fixed cost, right? So in these two things, Q is common, so you take Q. We have sale price minus variable cost minus total fixed cost, right? So we switched